Another week, another week of bloody market. Um, this week, I started thinking about dividend stocks. There have been so many YouTube videos talking about dividend stocks, and I've watched many of those, and many of them are really good with very in depth analysis and good research. But I noticed something that none of them, or at least I haven't seen any, mentioned uh, dividend stocks from life insurance companies. So I think I actually work in this industry, so I think it's probably good to bring this up and as an introduction for people to start paying attention to this particular sector. And the reason is why do we want to have stocks from life insurance companies for dividends? Well, the obvious reason is it has very high dividend yield, especially at the moment because the market conditions. So many of the stocks are actually more than half off. Uh, Here are just a few stocks that I'm going to talk about later. You can see they have 6 to 9%, almost 10% of dividend yield. And because of this market, the price is really good, and which means it's a really good time to start buying. Personally, I still want to observe a little bit longer because there's a lot of uncertainty out there because of this virus and because of the economic environment at the moment. So, but I think given how cheap they are right now, I will just start by one share at a time because there's no commission. So if you buy one share, it's probably just the lunch money or even less for some of those stocks that I will talk about. It wouldn't really hurt, especially with dividend. They normally don't cut it right away. Even if they do cut it, it will come back at some point. So for life insurance company, it's actually not just life insurance. They have a lot of other business for good diversification. For example, many life insurance companies also sell annuity products, which is the opposite of life insurance. For life insurance, if you die, the insurance company have to pay you a death benefit upon your death. But for annuity business, they actually pay you as long as you live. So on one hand, insurance company would lose money when someone dies, but also they save money if that person also has a annuity policy, so they stop paying that person. So it's just a simple example to illustrate how the products in life insurance company could have this hedging effect for each other. And also, many life insurance company also provides investment services, also investment business. Uh, for some of the companies that I will talk about, they actually manage 401ks for many employers, and they also have their own mutual funds. And some company, for example, Manulife, also has a large portfolio of real estate in many cities, both in U.S. and Canada. And especially large insurance companies, they also have pretty good geographical diversification. I will talk about that. For example, Manulife. I will talk about that later in the latest part of this video. And of course, there's this concern of what if this company goes under? Well, there's certainly that possibility, but in last 20 last 2 decades, the regulation has been really tightened up. So, for example, there's regular auditing for insurance companies that goes on either quarterly or at least annually, and they have to disclose a lot of financial information to the public and to the auditors. So there's a lot of a scrutiny in terms of what they do in their business. So that would be a preventive measure from the company for the company to stay on the track and avoid financial disasters on their own. Because of their own behavior, I guess. And also, there's a capital requirement for life insurance for insurance companies in general. But for life insurance company, basically, it would require the company to hold enough money that would absorb a large percentage of large percentage of losses if something happens. Uh, so in that case, insurance companies are protected both through the regular uh, regular auditing and also the all the other regulations, including the capital requirement. So it's relatively safe. So if you do a search, Google search, you just search for, like, say, best life insurance companies, you will see a list of companies. Uh, there may be all kinds of ranking, but the best ones or the top ones normally would be similar ones, depending on even with different sources of those that rank those things, but they should be similar. The list should be similar. And when you look at this list, you will see a lot of companies, but many of them actually don't have stocks because they are many of them are mutual companies. For example, New Northwestern Mutual and Pacifica Life, Mass Mutual, and anything with mutual is not going to be not going to have public traded stocks. And you can look into you can do a search to determine whether they are stock companies or not. And so I will talk about a few life insurance companies that I'm keeping an eye on. The first one would be Manulife. A lot of people probably don't know what about this company, but it's a Canadian company. It is also the parent company of a U.S. insurance company called John Hancock in Boston. Manulife bought John Hancock probably 10 or 15 years ago, and it has a business across many countries. And I think last time I checked, there were about 20% of the revenue or profit that's coming from Asia, and so it's a very very well diversified company in terms of global diversification. So if something happens in one part of the world, the other part, Manulife will still get money from other parts of the world where it has business in. And also, Manulife is not just an insurance company; it has all kinds of products. In Toronto and in Canada, basically a lot of large cities in Canada and also many large cities in the U.S. Manulife owns a lot of real estate that's rented out to business, so it's getting a lot of money from those. And also, Manulife has done a pretty good job in cutting the cost and making the system more efficient. So in terms of financials, it looks pretty good on that end. It also has some pretty innovative products, so it has a pretty good market. Well, in Canada, Manulife is one of the top three largest insurance companies, and there are not that many companies in Canada. You can count them with probably just two hands. So in that case, the Canadian government is definitely going to make sure that Manulife is gonna run smoothly, at least, and not gonna be a burden or go under anytime soon. So that makes Manulife a pretty good choice for dividend stocks. Right now, it has forward annual dividend yield of 8.5. Last year when I checked, it was about 5% ish. But that at the time, the stock price for Manulife was in the $16 or $20 range. Now it's only $9. So that's part of the reason that the dividend yield is higher. And I started buying it last week, but I don't really buy a whole chunk because I'm a very cautious person. I don't really have that much money anyway. So I only buy one or two shares at a time, considering it's only $9, $10. Even if it drops a little further, I'm only losing $1 or two. So I'm good with that. Another one is a U.S. company. It's called Lincoln Financial. It's based in Pennsylvania, I believe, and it also got hit pretty bad in the last couple of weeks. And right now we're looking at $17 per share. At its height, well, as you can see, it's actually at it's almost $80 in 2018. So it's a really deep discount. And if we look at the max, you can see the trend of this is it's actually pretty stable. It got hit at this point. It's probably 2008. Yes, it's 2008. But then it went back to this high $76 and then went down later. But still, overall, it's pretty stable. If we look at Manulife, look at its 5-year difference. Yeah, Manulife is actually fairly stable as well. It didn't really fluctuate that much. So Lincoln right now has a dividend of, I think it's 6% on 7%. Eight 832. So yeah, so Lincoln is another stock to look at to watch out for. And then the next one will be Prudential. I think Prudential is probably pretty well known because it has a lot of business in different areas, and it also manages 401k. I remember one of my former companies the 401k was managed by Prudential. And look at its 5-year. It's also pretty stable. Even look at the max, it's still overall trend is still going up. And the dividend for this one is about 9.9. So another good stock to look at if you want to put some in your dividend stock portfolio. And so I didn't really talk about how I'm only looking at those things pretty roughly. I didn't really show any research or any in-depth analysis, but it's just a recommendation for people to start paying attention to this kind of stocks, and then you can do your own research and decide what you're going to do with it. Since we're here, I also want to mention this stock AEG. AEG is actually the name for the ticker for Transamerica. It's a Dutch company. It's the Dutch company Aegon is the parent company of Transamerica. Right now it's at $2.38 per share, which is pretty bad. And I would avoid this stock because it has been going down for quite some time. The peak of this stock is at let's see, 98, and it has been going down since then. Back in 2008, the stock price of this Transamerica is around $9 during that crisis. And after that, well, a lot of companies also had a lot of companies are also had during that time, and then they all recovered and they all went up over the next 10, 12, 15 years. But Aegon never really did. Aegon actually just continued to go down, and from $9 during that 2008 crisis, and to this $2.38 at this time. So it's something that we want to avoid, because not only has it been declining in terms of stock price, it's also been selling out its business to other places. It has a it closed its business in Louisville, Kentucky, probably 10 years ago, and then a few years later, it also sold its business in North Carolina to another company. And right now, it's still doing certain things, just chipping things away little by little. And it also outsourced its admin system to an Indian consulting company. So I'm not even sure 5 years or 10 years from now if this company is still going to exist. So this, even though when you look at its dividend yield, it's pretty high. The dividend yield is 16.29%, but just this is the thing you don't want to touch, because once you spend your money on the stock, it's probably gonna go nowhere. It's probably gonna be gone in a few years. So so that's it. That's what my recommendation is. Well, not a recommendation, but it just pointing to certain direction that if you are looking to build your dividend stocks portfolios, don't forget about life insurance stocks, because they are a pretty good source. And I would put them in my HSA or Roth IRA, because the dividend is taxed at ordinary income. So if you put them in accounts like HSA or Roth IRA, then you won't have to pay any tax for that. Okay, that's it. Thank you for watching, and if you have any suggestions or comments, please feel free to leave them here, and I'll really appreciate that. Thank you.